As we close out a week that has been dominated by the first of the Mag 7 names reporting their earnings in Tesla with a big beat on that front, we've also seen the BRICS countries coming together and seeking to expand, and a lot of talk of the de-dollarization story, and also a raft of PMI numbers that really provided relatively mixed readings. Well, this new week sees the biggest week in terms of earnings and also a huge amount of economic data, as we see a week that starts in October and ends in November, culminating in the US jobs report. So this is the week ahead for the week starting Monday, the 28th of October. So here are the big ticket items according to Trading Economics for the week ahead. Certainly plenty to go at. And if you remember last week's video, I think I probably only had about 5 items on here. Well, in actual fact, I've had to cull a couple to just try and squeeze them all into this chart. And so the main theme here is that we see on Wednesday a significant pickup in data, most notably in Europe. And the US, where we see GDP data released across the likes of France, Germany, the Eurozone, and the US for the third quarter. We've got inflation coming out from Germany. That is the wider regional number. We're also wider countrywide number. We're also going to see regional numbers coming out as well. We've seen Australian inflation that same day. And then on Thursday, we've got PMI numbers out of China, the Bank of Japan interest rate decision, inflation data coming out of France, but crucially coming out of the Eurozone. And then that leads us into the core PCE inflation metric out of the US, personal spending and income data out of the US, and on Friday, Caixin manufacturing PMI from China. But really the big ticket item is the US jobs report. And we've got the ISM manufacturing PMI number. And if we cast our mind back, that has really grabbed the headlines over recent months. So certainly something to be watching out for. The first area we're going to talk about is Japan, and the reason for that is the weekend that will be just gone as we enter this new week sees the Japanese election coming into play. Of course, Ishiba came into power as the new prime minister. It was a surprise win for the ex-defense minister. And there was an immediate move towards the downside for the likes of dollar yen, as people saw him as someone that was going to continue on the sort of tightening trajectory. Bear in mind, he's not leading the BoJ, but there's a feeling that he would want the BoJ to maintain that upward pathway for interest rates. Well, what happened since then was that he came out with some comments that actually stood in stark contrast to those market views. The relatively dovish comments brought some upside in terms of dollar yen. And now we've got this election. And so whilst he called the election to strengthen his hand following a vote that essentially had sort of split the party, there was a feeling that, you know, the LDP, they always win. And so he's going to be able to really consolidate his power. It looks like he might see the opposite. It looks like he may have to concede to some people that aren't necessarily as well aligned to his views. And therefore, there's some question marks about whether he's going to have people that are really aligned with Shinzo Abe more so than him. And that whole Abenomics and low interest rate environment does then come into play. So, you know, that stands to reason that we're seeing further upside in terms of dollar yen. Of course, we've got the BoJ rate decision this time around. Do we see any major move? That's something we're going to get into. We've also got a few other notable releases over the course of the week. Industrial production, retail sales, that's on Thursday, unemployment rate on Tuesday, consumer confidence, you know, a lot going on in Japan for the week ahead. These are the expectations according to the Icon platform for the BoJ as things stand. Expectation 84% is that we're not going to see a rate hike this time around. December appears to be the time when everyone really starts to question whether we will or won't see a rate hike. 56% chance of a rate hike at that meeting. And that would be a 10 basis point move. The expectation beyond there would be, you know, maybe we see another rate hike at the January meeting. And so by and large, markets are expecting a fair amount. They're expecting a 10 basis point hike, maybe not at this meeting, but good chance at the meeting after that. And then similarly, essentially a coin toss for a hike again, the meeting after that. So December and January, potentially back to back rate hikes. Notably, we've just seen the Tokyo inflation gauge coming out at 1.8. So inflation certainly easing back. The justification for hiking rates seemingly going with it. But, you know, we do get into the realms where people start saying, well, look, we're at the level where previously we saw intervention from the BoJ. Will we see them intervene once again? 152, currently the level that we're seeing here for dollar yen. Are we going to see that intervention? You know, who knows ultimately. But what we have seen here is a very clear uptrend. We saw them intervening on a number of occasions around these toppy levels. And so whether we're going to see intervention from the BoJ remains to be seen. But certainly, if their actions were done with a view to driving down the likes of dollar yen, driving up the value of the yen, maybe they need to take action once again. In terms of the near-term price action, you can see here that we sort of bottomed out here. And certainly once we broke up through this level here, 149, that's what pointed towards a wider retracement coming into play here for dollar yen. So if we look towards the upside, you'd say the 61.8, which is a 153, and then the 76.4, which is a 157. Those are the next big areas of resistance to be looking out for. What I would say is that we're coming into a US election, of course, and so the US election generally brings heightened uncertainty. And so that is on the 5th. I'm recording this on the 25th. You know, we're a week and a half away essentially from the US election. And so there's justification for further upside for the US dollar in the lead up to that. But certainly, generally, if you look at historical standards, generally the equity markets do well after elections. Generally, that would mean the possibility of downside for the US dollar. And so we could see this roll over once again, but we haven't necessarily seen the thing to tell us that that's about to happen. And the thing for me would be a breakout from the current ongoing structure that we have set here, which is a very clear-cut intraday trend here. And so while we're seeing some downside at the moment, that doesn't necessarily mean that it's time to sell into this this move. I would say a move back below this 149 level would point towards an exit of this intraday uptrend and a potential for a resumption of that wider sell-off that we did see previously that dominated much of July and August in particular. So further upside, certainly a distinct possibility. It looks like we're going to see the BoJ hold off this time around, but will they set the stall out in a way that might make people believe that they're going to move in December and then in January, or perhaps not? Also, how's this election going to play out? There's going to be a lot of potential volatility around the Japanese markets as we move forward. Then looking at the Eurozone region, there's again plenty to be looking out for here. I've alluded to previously the fact that Wednesday really sees things pick up because we've got the GDP figures, the Q3 GDP figures coming out from the likes of France and Germany and the Eurozone. We've got inflation data coming out of Germany on that same day alongside jobs data. And then on Thursday, retail sales from Germany, inflation from France, then inflation from the Eurozone and unemployment from the Eurozone. The question mark here recently has been about whether we could see a 50 basis point cut from the ECB. Certainly some of the weakness in terms of the PMI numbers from France initially made people think that we could see that. Those claims have calmed significantly since then, and we've heard some commentary from the ECB saying they don't think that they're in a position to actually see a 50 basis point cut. Nonetheless, that's something that certainly will be the talk of the town. If we were to see weakness in terms of GDP, if we were to see weakness in terms of inflation, then it at least reprices a little bit more in that direction, albeit not necessarily pointed towards that being a base case scenario. This is the outlook in terms of the core CPI, and you'll notice that if we look back at where Eurozone inflation is at 1.7. So the core numbers are really what we're looking at for many of these countries now. And you can see that here in terms of the UK and the US, 3.3, 3.2, still well above the 2% target, of course, whereas the Eurozone certainly in a better position to get to that point. We can see here in terms of the breakdown for the core CPI number, the September metric came in very low for the month. So if you take September, August, July, June, we're tracking at a decent level, but things really ramped up in a heavy manner in February, March, April, May. And so you're looking at a 6-month timeline here where we've got a 5% annualized figure. And that's because it starts to sort of drift into some of those heavy numbers. What we're seeing over recent times certainly hasn't been too tough. Now, if we look at what's going to happen this time around, well, October's been stripped up from last year, 0.22. So it's quite likely we're going to stay at 2.7 or get down to 2.6. It's unlikely we're going to see really significant movements. But once we get into Q1 and Q2 of next year, we're going to see some really significant disinflation coming into play. For the time being, I think it's more likely that in the coming months, we see inflation go sideways, potentially move towards the upside in terms of core CPI, because we've got those negative readings for November and for January. So unlikely we're going to see significant moves for the time being in terms of those inflation metrics. The chart I wanted to bring up here is for Euro Swissy. This is something that has been trending lower very nicely recently. You know, it's funny because this might be the kind of thing that people want to trade, right? So something like that or something like this. But sometimes it can take a trend that looks more like that for something to be highly tradable. And the reason for that is that you can often get very significant retracements within this trend. So if we're looking for deep retracements, really depends on how you trade. But if you're looking at deep retracements, you can see down here, we've got a 76.4 fib. We actually hit it twice, but didn't break the price swing high. You can see that on the next one here, we got a deep fib retracement close to the 76.4 fib. The next one ultimately broke through that prior high, but the next move beyond that, we were looking at a nice deep retracement just below that 76.4 fib. So we've got the creation of low highs and lower lows in play here. Now, it's notable that Swiss interest rates are well below that of the Eurozone, but they don't necessarily have that far to move. With the Eurozone, we have them cutting interest rates, but we've also got question marks about where rates will end up. And it's likely that that number is probably going to continue to drift lower. Growth prospects not great in the Eurozone. So the ECB do have to act. I think markets are probably expecting too little when it comes to the ECB. I think they're going to do more in terms of for how long they're going to cut. Crucially, the rally that we've seen recently has taken us into the 76.4 Fibonacci level. So if we start breaking up through these recent swing highs, 0.94, and in particular 0.9427, that's when it looks like this recent downtrend is over. But as we move into a week where we're going to see GDP data and inflation data out of the Eurozone, if we see weakness across any of those figures, there's a good chance it does send this market back towards the downside once again and continue the bearish theme that has been playing out over the last month in particular, but certainly over the long term as well, right? So long-term trend is bearish. You're on the side of the long-term trend and the short-term trend on this one for the bears. And so unless we break through the swing highs, the likes of 0.94, 0.9427, I think there's a good chance that we do see this rollover once again. And finally, let's talk about the US. Of course, the US is going to be absolutely key for the week ahead. And that's because we've got the jobs report coming out on Friday. With the jobs report coming out on Friday, it means that we also see jobs data coming out over the course of the week. We've got the JOLTS job openings numbers on Tuesday. We've got the ADP payrolls number on Wednesday. Thursday, we've got the jobless claims. And Friday, we've got the jobs report. Alongside that, we've got GDP on Wednesday, we've got core PCE inflation on Thursday, and we've got the ISM manufacturing PMI. It's mad because all of these numbers can move the markets. We've seen major volatility just off the back of the ISM manufacturing PMI over recent months. Of course, GDP has the potential to move markets and grab headlines. And the core PCE price index, of course, is the favored inflation metric for the Federal Reserve. Here's a rough overview on where things are in terms of the US jobs market at the moment. Notably, we've seen a pickup in terms of payrolls, sort of the blue line in the middle. So we've seen some of the fears around a potential recession in the US easing, with the unemployment rate moving towards the downside, down to 4.1, the payrolls number moving towards the upside. Yes, we've been seeing downside figures in terms of like the quits, the job openings, hires. There's certainly some sort of tightening within the jobs market, and there's a lack of confidence in terms of, oh, there's millions of jobs for me to get into if I want one, and therefore I'll just quit my job. There's a lot less of that, notably, but that doesn't mean that we're seeing a potential recession. We're not seeing a massive surge in terms of unemployment. So as things stand, we're talking about a soft landing or no landing in the US. We're not talking about a hard landing. In terms of this is not the labor market dashboard. This is the breakdown for core inflation in the US. Notably, the last two CPI figures have come in hot. 0.281 on the August monthly figure, 0.312 on the September number. Generally, we do see them moving in a similar kind of trajectory between the core PCE and the core CPI. But that didn't really happen in August because we saw the PCE metric down at 0.13, the CPI number at 2.81. Will we see it picking up this time around? Markets aren't necessarily expecting it. But if you look at what's happening in terms of CPI, there is a possibility it comes in a bit higher. Markets are looking for the core PCE figure to... That's not actually on here. I think the expectation is that it's going to move up to... not move up, it's going to stay flat at 2.7, I believe. And I think there's a good chance that that does happen. I don't necessarily think that we're going to see a move towards the downside. Irrespective, I don't necessarily think that it's going to, unless we see sort of significant moves, don't think it's going to really grab the headlines in a meaningful way. The key thing here is, do we see the US economy really struggling to the extent where we need to see another 50 basis point cut? I don't necessarily see that personally. And that's part of why we've seen that repricing of expectations for the Federal Reserve, part of why we've seen the strength in terms of the US dollar over recent weeks. And leading into this US election, I wouldn't be surprised to see a little bit more of that caution within markets and strength for the likes of the US dollar. In terms of the market that we're looking out for here, I wanted to bring up the chart for the Dow Jones Industrial Average. Here it is. And essentially, we're looking at a market that has been pulling back over the course of the week just gone, feeding within a very bullish trend here. Certainly why I wanted to bring this up is that it doesn't necessarily have as many of the big tech names. This coming week has a host has got 5 out of the 7 Mag 7 names reporting. So those earnings are really going to move the tech sector in particular, whereas the Dow is less heavily influenced by that. We can see here, though, we've seen a pullback in towards that 76.4 Fibonacci level and looking like the bulls are back in charge as we close out one week, entering a new one. Will this mark the beginning of another bullish phase? We've seen some caution coming into play of late. Certainly a breakdown through this 41801 support level would point towards a wider pullback coming into play. But until that happens, it's a good chance that the bulls do have a chance of returning to the 4, and crucial to that would be a breakup through your 42528 swing high, which at the moment we're moving towards. So by the time you watch this video, perhaps we've broken it, and it gives us that inkling that perhaps the worst is over with that pullback into 76.4 fib and then the breakup through that swing high. But like I said, if we break the 41801 level, that's when it looks like we're going to be posting a wider retracement for the Dow Jones Industrial Average that's going to be trading within a week of plenty of volatility when it comes to the likes of earnings season, where we've got, like I said, 5 out of the 7 Mag 7 names reporting. So this is the biggest week in terms of earning. But if you look at that sheer number of data points coming out of the US, it is a joke, quite frankly. The ISM manufacturing number, the GDP number, all of the jobs numbers, and the core PCE price index. It's going to be an absolutely massive week ahead for markets coming the week before the US go to the polls. So plenty to play for as we move forward. I hope this has been useful. We'll make sure to provide you with plenty of content as we go forward here at Scope Markets.